Nathan got a raise in April. Not a small one. A real one. His salary went from $74,000 to $91,000, and for about 2 weeks, he felt the specific, uncomplicated happiness of knowing that the years of work and patience had produced something tangible. He updated his direct deposit. He told his wife. He felt, for perhaps the first time in his adult life, genuinely ahead. 3 months later, he was approved for a mortgage. The bank was enthusiastic. His loan officer was warm and efficient and made the whole process feel not just manageable but almost congratulatory, as though the bank was doing him a favor by lending him money. They approved him for $480,000. His monthly payment on a 30-year fixed mortgage at the prevailing rate would be approximately $2,900. He bought the house. It was a good house. He felt like he had arrived at something. 18 months later, Nathan's financial life looked like this. His mortgage payment consumed 38% of his take-home income. He had a car loan he'd taken on 6 months after the house because the old car felt inconsistent with the neighborhood. He had a home equity line of credit the bank had offered him proactively, which he'd used for renovations that seemed reasonable at the time. He had 3 credit cards, 2 of which carried balances, because the mortgage and the car payment had created a monthly cash flow that was technically positive, but practically fragile. One unexpected expense, and the cards were the solution. The cards were almost always the solution. Nathan earned $91,000. He felt like he earned considerably less. Now I want to tell you about a woman named Claire. Claire earned $88,000 that same year. $3,000 less than Nathan. She also got a mortgage, also bought a house, also had a car. Her bank also approved her for significantly more than she ended up borrowing. The approval was for $440,000. She borrowed $280,000. Today, Claire's mortgage payment is $1,680 per month. She has no car loan. No HELOC. One credit card with a balance she pays in full every month. She has $1,400 in discretionary cash flow after every fixed obligation is covered. She doesn't feel rich. She feels free, which she has learned is a completely different thing. The difference between Nathan and Claire is not income. It is not intelligence, discipline, or character. It is one thing, repeated across several financial decisions, that Nathan never saw coming because nobody showed it to him in advance. The bank told Nathan what he could borrow. Claire understood what the bank was actually doing when it made that offer. Pause. Music fades in softly. This isn't about borrowing responsibly. It's about understanding that banks use your income not to help you afford more, but to calculate the maximum they can extract from you while keeping you technically solvent. And the gap between what they'll approve and what you should actually borrow is where most people's financial freedom quietly disappears. I'm going to show you the exact rules of how banks use your income against you, the specific mechanisms, the products, the psychological tactics, the approval frameworks that are designed to work in the bank's interest while appearing to work in yours, and the precise knowledge that separates people who use banks as tools from people who are used by them. These are the things your loan officer will not explain. And understanding them is the difference between a financial life that works and one that merely appears to. Transition to core content. Rule 1. The bank's approval amount is not a recommendation. It is the maximum they calculated they can lend you before the risk becomes unacceptable to them, not to you. This is the foundational misunderstanding that explains Nathan's situation entirely. When a bank approves you for a mortgage of $480,000, most people hear that as a kind of financial endorsement. The bank has looked at your income, your credit, your debts, and your assets, and it has concluded that $480,000 is a number you can handle. It feels like validation. It feels like the responsible, credentialed institution has done the math and given you a ceiling you can trust. What the bank has actually done is calculate the maximum loan amount at which their statistical models suggest you are unlikely to default, where the risk of you failing to repay falls within their acceptable loss parameters. The calculation is calibrated around their risk threshold, not your financial well-being. The bank is not asking whether this loan will allow you to save for retirement, maintain an emergency fund, handle unexpected expenses, or live a life that doesn't require perfect conditions to remain solvent. The bank is asking whether you will probably keep making the payment. Those are profoundly different questions. Here's the real-world consequence. The bank-approved maximum typically pushes debt-to-income ratios to the upper boundary of their guidelines, often 43% for conventional mortgages, meaning your total monthly debt payments can equal up to 43% of your gross monthly income. On Nathan's $91,000 salary, 43% of gross monthly income is approximately $3,260. His mortgage, car loan, and minimum credit card payments combined are approaching that figure. He is living at the edge of what the bank considered acceptable risk. That edge has no cushion for the real financial life that happens on both sides of a monthly payment. The psychological insight is that the approval feels like permission. The number arrives from an authoritative source through a formal process, and it lands in your mind as a ceiling you can reach rather than a limit designed around someone else's risk tolerance. Treating the approval as a budget is one of the most expensive financial mistakes available. The approval is information about what the bank will do. It tells you almost nothing about what you should do. Rule 2. Debt-to-income ratio is the metric banks use to determine your maximum loan, and it is deliberately calculated on gross income, which makes your actual affordability look significantly better than it is. This is the specific mathematical trick embedded in every lending approval, and almost nobody outside the banking industry ever explains it plainly. Your debt-to-income ratio, as banks calculate it, divides your total monthly debt payments by your gross monthly income, your income before taxes, before retirement contributions, before health insurance premiums, before any deduction of any kind. The number that results looks favorable because the denominator is as large as possible. Here's what that means in practice. Nathan earns $91,000 per year. His gross monthly income is $7,583. The bank's 43% debt-to-income threshold allows total monthly debt payments of $3,260 on that gross figure. It looks manageable. But Nathan's actual take-home income, after federal and state taxes, Social Security, Medicare, and his health insurance premium, is approximately $5,400 per month. His $3,260 in monthly debt payments represents 60% of his actual take-home income. Not 43%. 60%. And 60% of your actual income going to debt service is not a financial life. It is a financial trap with a comfortable-looking entrance. But here's what most people miss. The bank knows this. The bank understands that gross income and net income are different. The bank uses gross income anyway because it produces a more favorable ratio that allows larger loans. The framework is not an oversight. It is a design choice that systematically enables banks to lend more than would be supportable if the calculation were done on the income that actually lands in your account. The correction is simple and should be mandatory in any personal financial decision. Before you evaluate any loan's affordability, calculate the monthly payment as a percentage of your actual take-home income, not your gross. What actually arrives in your checking account after everything is withheld. If that percentage feels uncomfortable, it is because your actual financial life has to operate on that number, regardless of what the bank's ratio says. Rule 3. Banks pre-approve you before you need the money, and the timing of that pre-approval is not coincidental. It is engineered to catch you before you've thought carefully about what you actually want to borrow. Pre-approval letters arrive at curious moments. You mention to someone that you're thinking about buying a house, perhaps you're not even actively looking, and suddenly your bank is offering a pre-approval. You've had a recent income increase. You've been a customer for several years. The offer appears warm and unsolicited, with a number attached that feels like an opportunity. Pre-approvals are marketing instruments before they are financial services. Banks generate them when customers are in exploratory, emotionally open states, when the decision hasn't been made, when the budget hasn't been set, when the emotional excitement of possibility is highest and the analytical rigor of commitment is lowest. The number in the pre-approval letter anchors your thinking before you've had the chance to anchor it yourself. Behavioral economists call this anchoring. The first number you encounter in a decision process becomes the reference point against which all subsequent numbers are evaluated. A pre-approval of $480,000 means that a $350,000 house feels conservative, almost unnecessarily modest. A $420,000 house feels reasonable. The anchor is set. Your independent assessment of what you can comfortably afford has been preempted by a number generated by an institution with a financial interest in you borrowing as much as possible. Claire received the same kind of pre-approval. She was approved for $440,000. She read the letter, noted the number, and then spent 3 weeks doing a completely separate calculation based on her actual take-home income, her actual savings goals, and the monthly payment she could afford while maintaining the financial margin she refused to sacrifice. That calculation produced $280,000. She borrowed $280,000 and ignored the anchor entirely. Nathan used the pre-approval as his starting point. Claire used her own math. The pre-approval was the same type of document for both of them. The relationship each of them had with it was completely different. Rule 4. Banks profit from your payment consistency, not your financial health, and these two things are not the same, even though banks present them as though they are. This is the central conflict of interest that most people never examine. A bank that lends you money profits when you make consistent payments over a long period of time. The longer the loan term, the more interest you pay and the more the bank earns. A 30-year mortgage generates significantly more interest income than a 15-year mortgage on the same principal. From the bank's perspective, a borrower who makes minimum payments for 30 years and pays 2 to 3 times the original loan amount in total interest is an ideal customer. A borrower who pays off the loan in 12 years is a less profitable one. Your financial health, by contrast, is served by paying as little interest as possible, maintaining as much financial flexibility as possible, and eliminating debt as quickly as is consistent with your other financial priorities. These objectives are not aligned with the bank's profit maximization. They are, in many respects, directly opposed to it. Here's the number that makes this concrete. Nathan's $480,000 mortgage at 6.5% over 30 years will cost him approximately $614,000 in interest over the life of the loan, in addition to the $480,000 principal. Total paid, $1,094,000 for a $480,000 house. The bank earns $614,000 from Nathan's purchase. Nathan's bank did not offer him a 15-year mortgage at the same rate, which would have cut that interest cost to approximately $270,000, saving him $344,000. The bank offered him the product that maximized their return. Nathan accepted it because it offered the lowest monthly payment, which the bank knew he would prioritize. The bank is not Nathan's adversary, but it is not his financial advisor either. It is a profit-seeking institution offering products calibrated to its own financial interests. Treating it as a neutral party in a transaction where it has a significant financial stake in one specific outcome is a category error that costs most borrowers hundreds of thousands of dollars across a financial lifetime. Rule 5. Credit limit increases are presented as rewards for good behavior. They are actually invitations to carry larger balances and pay more interest. Nobody sends you a credit limit increase letter that says, "We've noticed you've been managing your current limit well, so we'd like to give you the capacity to go further into debt and pay us more money." That is what the letter means. That is not how it reads. Credit limit increases are framed as trust, recognition, and financial empowerment. Your responsible behavior has earned this. You've demonstrated that you can be trusted with more. The subtext is that accepting the limit increase is the behavior of a financially capable adult, and declining it is somehow unnecessarily cautious. The mechanism is deliberate. Banks know from decades of consumer data that credit limit increases lead, on average, to higher carried balances. Not immediately. Not for every customer. But across the population of customers who receive limit increases, carried balances grow. The utilization rate, the percentage of available credit being used, stays roughly constant while the limit goes up, which means the absolute balance goes up proportionally. It gets worse. Credit limit increases also have a psychological effect on spending patterns independent of actual card use. Research on mental accounting shows that people spend more when they perceive their available resources as larger, even if they don't consciously intend to. The higher limit changes your unconscious reference point for what counts as a dangerous balance. A $3,000 balance feels very different when your limit is $5,000 than when your limit is $15,000, even though the balance is identical and the interest cost is identical. Claire has never accepted an unsolicited credit limit increase. Not because she doesn't trust herself with credit. Because she understands that the limit is not information about what she can afford. It is information about what the bank wants her to spend. Rule 6. Banks offer home equity products immediately after you've built meaningful equity, and the timing is engineered to convert your wealth into their revenue. This is the mechanism that completed Nathan's financial trap and the one he least expected. A HELOC, a home equity line of credit, is a genuinely useful financial product in specific, well-considered circumstances. It can fund meaningful home improvements that add value, bridge temporary cash flow needs, or provide emergency liquidity for households that don't maintain separate liquid savings. Used thoughtfully, it is a reasonable tool. Banks do not offer it for these thoughtful applications. Banks offer it the moment your loan-to-value ratio improves enough to make you eligible, often proactively, by mail, shortly after your home appreciates or your balance decreases enough to unlock the equity. The timing is calculated. You have recently built something. The bank is immediately there to help you spend it. The framing is almost always about access to your equity, as though the bank is simply making available something that is rightfully yours. Your home has increased in value. You should be able to use that value. Here is a convenient product that lets you do exactly that. The framing is not wrong, but it omits the key detail that using the product converts equity, which is your wealth, into debt, which is their revenue. You are not accessing your equity. You are borrowing against it and paying interest for the privilege. Here's the hidden consequence that most people discover only after the HELOC is used and the renovation is done. A HELOC balance increases your total debt load, reduces the equity buffer in your home, and adds a monthly payment obligation to your fixed expense structure. The renovation may or may not have added equivalent value to the property. The debt is certain. The added value is an estimate. And if home values decline, a HELOC can leave you with a loan balance that approaches or exceeds your home's current worth, eliminating the equity that was your primary financial safety net. Nathan's HELOC was offered proactively, accepted impulsively, and used on improvements that felt urgent and turned out to be mostly aesthetic. The bank knew his equity position precisely. It made the offer at the exact moment his eligibility crossed their threshold. He received the letter and thought his bank was being helpful. Rule 7. Banks make money when you refinance, and the refinancing pitch is carefully timed to maximize their origination revenue while appearing to serve your interest. Refinancing can be a genuinely valuable financial decision. When interest rates have fallen significantly, refinancing a mortgage can reduce your monthly payment and total interest cost in ways that more than offset the closing costs of the new loan. The math is real. The benefit is real. What is also real is that banks generate significant fee income, origination fees, processing fees, closing costs, every time you refinance. A refinance that produces meaningful savings for the borrower also produces meaningful revenue for the bank. And banks market refinancing aggressively through direct mail, email, and proactive calls from loan officers in ways that are not always calibrated to the moments when refinancing is actually in your interest. The specific trap is the rate and term refinance that resets your loan to a new 30-year term. If you are 12 years into a 30-year mortgage and you refinance into a new 30-year loan, even at a lower rate, you have extended your debt obligation by 12 years. The monthly payment goes down. The total interest paid over the new life of the loan may be equivalent to or higher than the remaining interest on the original loan. The bank earns origination revenue on the new loan. You have a lower payment that will last until you are significantly older than you planned. The calculation that the bank's refinancing pitch almost never volunteers is, what is the total interest I will pay over the remaining life of my current loan versus the total interest I will pay over the full term of the new loan? That comparison produces a different picture than the monthly payment comparison the pitch emphasizes. Monthly payment reduction is the visible number. Total interest comparison is the revealing one. Rule 8. The savings account the bank offers you pays you as little as legally possible, while the bank uses your deposits to fund loans at rates many times higher. This is the most transparent mechanism of banking, and it is also the one that people most consistently accept without examination. The basic banking business model is straightforward. Banks accept deposits and pay depositors interest. Banks lend those deposits to borrowers and charge borrowers interest. The difference between what they pay depositors and what they charge borrowers, the spread, is a primary source of bank profit. Maximizing this spread means minimizing what they pay you and maximizing what they charge borrowers. The national average interest rate on savings accounts at the largest banks has, for most of the past 15 years, been between 0.01 and 0.1%. During the same period, those banks were lending money on credit cards at 15 to 25%, on personal loans at 8 to 20%, and on mortgages at rates that, while lower, still produced a substantial spread above the near-zero deposit rate. The money in your savings account at a major bank is being used to fund loans that earn the bank 25%. You are receiving 0.05% for the use of that money. The bank is earning a return on your deposits that is, in some cases, 500 times what it is paying you. High-yield savings accounts at online banks and credit unions routinely offer rates that are 20 to 50 times higher than the rates offered by the largest traditional banks, without any meaningful difference in deposit insurance protection or accessibility. The rate difference between a 0.05% traditional bank savings account and a 4.5% high-yield account on a $20,000 balance is approximately $890 per year. That $890 is not going to make you wealthy. But it is yours, and your bank is currently keeping it, and it will continue keeping it for as long as you don't move the money. Rule 9. Banks use your payment history to identify your price sensitivity, and they charge you more if they've determined you're unlikely to leave. This rule applies specifically to credit cards and revolving credit products, and it operates almost entirely below the level of awareness for most customers. Credit card interest rates are not fixed by any external market force in the way that mortgage rates are influenced by the federal funds rate. They are set by the issuing bank within regulatory limits, and they vary significantly across customers based on risk assessment and, increasingly, on behavioral modeling of customer retention likelihood. What this means in practice is that customers who carry balances consistently, who have never called to request a rate reduction, and who have a history of making minimum payments without closing the account are identified as price-insensitive. Customers who will pay whatever rate they're charged without taking action. And price-insensitive customers are systematically charged higher rates than customers who demonstrate awareness of and engagement with their terms. But here's what most people miss. Calling your credit card company and asking for a rate reduction works more often than most people realize. Studies of this specific behavior consistently find that customers who call and request a rate reduction receive one a significant percentage of the time. Often 40 to 60% of attempts result in at least a partial reduction. The bank would rather reduce the rate slightly than lose a customer who is currently paying a high rate on a carried balance. The customer who never calls receives no reduction. The bank keeps the spread. The practical action is a 5-minute phone call. The script is almost embarrassingly simple. You call the number on the back of your card, you tell the representative that you've been a customer for a number of years, that you have been offered competing cards at lower rates, and that you would like a rate reduction before you consider a balance transfer. That is the conversation. It has a meaningful probability of producing a result that saves you real money. Most people never make the call because they don't know the reduction is available for the asking. Rule 10. The most profitable bank customers are not the wealthiest ones. They are the most financially unaware ones, and banks design their products, communications, and service models to keep awareness low. This is the rule that frames everything else in this video. And it is stated plainly almost nowhere in mainstream financial discourse. The customers who generate the most fee and interest income for banks are not high-net-worth individuals who maintain large balances and borrow occasionally at competitive rates. Those customers are negotiated with, competed for, and offered favorable terms. The customers who generate disproportionate revenue are the ones who carry credit card balances, who don't shop for better savings rates, who accept the mortgage approval amount as their budget, who use overdraft protection regularly, who don't read their statements carefully enough to catch errors or fees, and who treat their bank as a trusted advisor rather than a profit-seeking institution. The bank's communication strategy, the language of partnership, the congratulatory tone of approvals and limit increases, the helpful framing of refinancing offers and HELIC invitations, is calibrated to maintain a relationship that feels collaborative rather than transactional. Banks are very good at this. The feeling of being a valued customer is a product the bank manufactures because customers who feel valued don't comparison shop, don't negotiate, and don't notice the systematic ways in which their financial behavior is generating revenue for an institution that is not managing their financial interests. Claire knows this. She is not hostile to her bank. She uses it efficiently for the services it provides at competitive terms, and she treats every offer, every approval, and every proactive communication from her bank as information about what the bank wants rather than guidance about what she should do. That mental model costs her nothing and has, over time, saved her an amount she can trace through specific decisions, the borrowed amount she rejected, the limit increase she declined, the HELIC she didn't open, the savings she moved to a high-yield account 5 years ago. Nathan's bank is not his enemy, but it has never been his advocate. And the $91,000 salary he was so proud of in April has been, without his knowledge or consent, the primary input in a series of calculations designed to extract the maximum sustainable revenue from his financial life. He is an excellent customer. Claire is not. And that distinction, compounding over decades, is the entire difference between them. Transition to closing. Nathan and Claire both earned good salaries. Both bought homes. Both used the same banking system, the same credit products, the same basic financial infrastructure that everyone uses. The difference between their financial lives today is not explained by income, intelligence, or virtue. It is explained by a single, repeated, consistently applied understanding that Claire carried into every financial interaction with every institution. She understood that the bank sitting across the table from her, whether physically at a desk or functionally through an approval letter or a product offer, was not a neutral party. It was a sophisticated institution with decades of behavioral data, carefully designed products, and a profit motive that was real and legitimate and fundamentally misaligned with her specific financial interests. She did not resent this. She simply accounted for it. She brought her own math. She set her own anchors. She made her own decisions and used the bank's products where they served her and declined them where they served the bank more than her. Nathan trusted the process. He trusted the approval. He trusted that the proactive offers arrived because the bank had determined they were good for him. He trusted that the institution managing his mortgage and his deposits and his credit was doing so with his financial well-being as a genuine priority alongside its own. It wasn't. It never presented itself as doing so. He simply assumed it because the alternative, that the system he was depending on to help him build financial security was actually optimized to extract maximum value from his income, was too uncomfortable to sit with without direct evidence. This video is the direct evidence. The raise Nathan got in April was real. The enthusiasm the bank showed for his new income level was also real. Both things were true simultaneously. His salary went up. The bank noticed immediately. The question for you is whether you'll notice what happens next. OUTRO, measured, calm, purposeful. End card. If this video changed how you see the next offer, approval, or rate your bank sends you, share it with one person who is about to borrow more than they should because a number arrived in an envelope and felt like permission. The next video in this series covers the exact negotiation conversations that most bank customers never have, the ones that routinely produce lower rates, waived fees, and better terms from institutions that were counting on you not to ask.